Hello everybody, we are live, back with our power lunch.
We have a new background.
We are in a mess right now. We just moved
Yes,
and
we
we
did.
haven't fully unpacked yet.
It's been a crazy couple of weeks.
As usual.
You probably noticed that we weren't here last week, and we were just like in the middle of,
Everything.
yeah, just everything. It was a bit
So-
crazy. So,
unfortunately we missed last week, but we are back. We're back now. We're not fully set up. Our lighting and everything is not right, but we didn't want to miss this, so we're here for you. If you are a passive investor, you don't want to miss this.
this one's for you.
This one is for you.
This
That's
one's
right.
for you. Because we talk a lot about, because we're active partners. So we talk a lot about how to be an active partner, how to build your active investing business, how to look for deals. All of that as an active partner. And we don't want to forget our passive partner friends, because you're also not off the hook just because you're passive when it comes to finding a good deal to be
Yeah.
investing in.
You need to vet the people that you're investing with, and the deal that you're investing in. So we've talked previously on other power lunches, so you can go back into our YouTube and watch the other ones where we've talked about how to find the right partner and how to vet partners and that kind of thing. But now today is more about the deal.
Yeah, exactly. So if this is your first time joining us on one of our power lunches, welcome. We like this to be as interactive as possible. So, if you, first of all, say hi, let us know that you're here. And then if you have something to say, if you have a question, something you want to add to the conversation, make sure you comment and we will add that to whatever we're talking about. Otherwise, it's going to be us talking, bantering back and forth, which can also get pretty exciting. But we do want you guys to have some input and some involvement as well. So say hi. Let us know if you want to add anything to the conversation. If you've joined us before, you know the drill. Welcome back. We like to have a little bit of fun on this as well. If you've missed any of our previous ones, like Jeff said, these are live on Facebook, but they are also on our YouTube, so you can go back. We've been doing this for over a year now. I keep getting memories of ones that we were doing last year at this time. So there's a ton of these on our YouTube channel. You can go back and look at all the different things we've discussed, from mindset to due diligence to stabilizing your property. We've talked about a ton of stuff, so you can go and check that out on our YouTube page.
Yeah.
So that's that.
Now that we got that out of the way,
So, like we said,
what you've come for.
yeah, like we said, this is for our passive friends, because we want you to not feel left out, because you are an important piece of the equation when it comes to a lot of active partners doing deals, and we want to make sure that you are also protecting yourself, because I think it's really important. I know we talked about this last time when we talked about picking the right partner, but there's a lot of scary things that have come up in especially with social media. A lot of things have surfaced that I think make people a little bit weary,
Uneasy.
So it's important to know sort of what you're looking for as a passive partner, because you don't want to just go into a deal blind. So do go back, watch the video about how to kind of vet a partner. Some of the things we talk about are, have an actual conversation with that person, get to know their goals, get to know kind of their track record, talk to some of the people they've worked with before.
Get references,
Yeah, gut feeling is a big thing. We talk about that a little bit in that video. And then something that we like to talk about as well is, it's one of my new favorite terms, and what's it called? Do you have a word that you like?
Anagram?
No, well, yeah, but like words that you live by, or values.
Value.
Sorry guys, words have been really hard the last couple days. I'm not gonna lie, this might be a bit rough. Uh, but one of the things that, like a word that's not a word that I've recently, come across, and I love it as a value for us because I think it's so true, is Dwizzy would. So do what you said you would do. And I think that's really important as a passive investor to find someone who truly does that, because things are going to get rocky at some point. Buy and hold real estate, you're going through the cycles. Not everything's going to be perfect. Things are going to get a little bit rocky. But if you're partnered with someone who really lives by that, like, Dwizzy would value, they're going to do everything they can to make sure that you as an investor are protected. And I think that's really important, as far as a characteristic to have as an active partner. So if they have a history of, burying their head in the sand and not really dealing with any problems, or if they say they've never run into any problems in their years of investing, take that with a grain of salt and be a little bit concerned. If they have if they have stories about issues they've run into and they can talk about, what they did and what the outcome was, it's the fact that they've been through those things and they've been able to work through them. I think that's really important as an active investor and as a passive investor to ask those questions. It's better if they've gone through a problem and they were able to solve it.
Yeah, another big thing is to make sure that your goals align, right? That your goals as a passive investor align with the goals of the active investor. Mm-hmm. Do you have the same kind of, I don't know, let's say it's a 5-year project, a 10-year project. Do you have the same goals and the same vision for the next 5 to 10 years? Mm-hmm. If we're talking buy and hold real estate, that's typically your range, if not longer. Mm-hmm. If it's just a flip, again, do your goals align with the active investor?
Yeah.
Do you want to sell a property in 1 year? Or are you looking for a buy and hold? Right? Yeah. You want to make sure that the goals that you have as a passive investor align with the goals of not only the partner that you're looking for, but the deal that they're bringing to the table.
Yeah, there's a lot of trust when it comes to working a deal, and you want to make sure that you would sort of act in the same way that your active partner would, because if they're going to do something completely out of left field and you would go that direction, maybe that's not a good fit, or
that's where this is going to happen,
or maybe it's a good thing and they're actually making a really good decision and you would have made a maybe not as good or as experienced decision. But you want to make sure that you have the same goals, the same values. If the plan for the project, this happens a lot, if the plan for the project is to evict all the tenants and you don't really align with that as far as your values go, then maybe that's not the right project for you, even if the
ROI.
Yeah, the returns look really good. Maybe that's not a part of your value system. So you don't like the idea of having to evict a ton of tenants to, increase the value of a property. So that's kind of picking a partner, making sure your goals, your values align, or at least that you like the values that the passive or the active partner has, because they essentially are going to be acting on your behalf as far as managing the property goes, especially for kind of the day-to-day.
Yeah. Moving on. We didn't come here to talk about the people. We came to talk about the deal. So we spent too much time talking about that, I think.
That's okay. I think it's important to
again,
reiterate.
that's kind of a refresh of what we would have talked about in the other video. Go watch that for more detail. So what do we look for as a passive investor in the deal that's being brought to the table? Not only the person, but what about the deal?
Yeah, I think that kind of goals discussion also translates really nicely into the discussion about the project as well, because you want to make sure that your investing goals make sense with the type of project that you're getting into. If you're somebody who likes a really fast turnover game, you're okay with a little bit more risk. Maybe you want something that's more like a flip project or a major burr project. If you're someone who has a lower risk profile and your goal is more to put your money into somewhere it's going to be safe, it's going to grow, it's going to be kind of protected from inflation because it's going to inflate with the building, then maybe something that's more in the buy and hold space is going to make sense. So having a really good understanding of what your goals are and making sure they align with the project goals, I think, is really important. It's not always about finding the deal with the highest ROI. necessarily.
That depends on what your goals are, right?
Yeah.
If you have high risk, then a high risk tolerance for your investing, then it's okay, go after the highest ROI that you can find, right? Because with that, it's going to be relative to the risk of the deal. But if you are somebody that wants a low risk investment, you can't go after the highest ROI that's out there, because that's going to be tied to the higher risk deals.
Yeah,
right? So that understanding that concept, I think first and foremost, is really important, to know that high risk typically has high reward.
It also has potential for
downfall. But again, it's risk.
Yeah.
I guess I should say that the other way. High reward typically comes with high risk. That's a better way to put it.
Yeah, exactly. And that's where, like, real estate's kind of nice, because you have a bit of variation as far as what's available to you with real estate opportunities. And typically, as long as things are done properly, you can mitigate a lot of those risks along the way. But there is still a variance in, are you doing a flip that's really dependent on, emotion and big renovations, potentially, evicting tenants. We know, like, we're in Ontario, we know that's a very difficult thing to do. So are you okay with that risk of we're kind of betting on that after repair value, and we've mitigated as much risk as possible, but we understand that it's really dependent on hitting those targets to have the deal work. So understanding that in yourself, I think, is really important. And if you want the high ROI, that's great. If you're more like mitigating risk, that's also okay. You just don't have to chase the highest ROI. If the deal makes sense with what you want and the returns are good, that's okay too.
Yeah. I think I find there's a lot of people that are looking to almost make up for what they feel like is lost time as well. And so they're just chasing the highest ROI and not really thinking about, does the goal for this deal actually match my goals, other than the ROI, right?
Yeah.
Where it might just be like a very fast, high risk project or something like that.
Yeah, and it's interesting because we've talked to a lot of people that have they've kind of held on to their money for a really long time, because they're almost looking for that absolute, like, unicorn of a deal that, like, fits every single box that they're looking for, and checks off everything. It's basically a unicorn project that they're looking for, and because of that, they've held on to their money, and they keep looking for these new projects, and you go back to them kind of months later, and you're like,
or years later.
Yeah, like, okay, like, what have you been up to? I know you're looking for this type of project to get into, and they're like, oh, still looking. And I'm like, okay, but
what's the return on no investment?
Yeah, I'm like, okay, but it comes down to a point that you need to kind of to pick a project. Yeah. Because there is...
People get stuck in that analysis paralysis, right?
Yeah, and there's something to be said about lost opportunity as well. So,
for sure.
They're chasing that highest ROI in, a deal that makes sense for them, when the reality is that actually doesn't really make sense, but they've lost opportunities along the way. So don't get stuck in that, like, analysis paralysis piece, and hopefully some of this helps you work through that, because you'll have a better idea of what it is that you're looking for. So I think one of the biggest, and this is a very, like, broad topic, but it's, does the deal actually make sense? I think is, because I've seen some deals and I'm like, this doesn't make sense. Like, I like to think that I'm a pretty educated investor at this point, and it doesn't make sense to me. So I think you have to use a lot of critical thinking. I know you want to be passive, I know, but you still have to have a little bit of education, a little bit of critical thinking, because you have to make sure that what's being presented to you actually is logical to what is going to happen.
Yeah. At the end of the day, you're not fully off the hook, even though you're passive, right? You still need to understand what makes a good deal.
Yeah.
How do you make an informed decision about your investment if you don't fully understand what you're investing in?
Yeah.
Right?
And again, part of that is the track record of the person that you're investing with. So, but we've already talked about that. But does their plan make sense? We talked about the fact that we are in Ontario, and if the plan for the project to work is they're in Ontario and they have a 20 unit building, and they're like, we're going to turn everybody over in the next year and evict everybody, cash for keys, whatever their plan is, and then we're going to cash flow and the returns are going to be insane, and this is what the return is going to be. That's the plan. It sounds great, and is it possible?
Maybe.
Sure. But is it actually, is it realistic? Is that a realistic plan for this property? So that's when you need to start to think, okay, this plan sounds great. Does it actually make sense? Even if they want to evict 50% of the units in a 20 unit building, does that even make sense? Or what's logical for this property?
And then what happens if they can't, right? Mm-hmm. What happens if they can't evict all of the people that they want to evict? And what happens at that point? You're sitting in a negative cash flow deal potentially for longer than you anticipated. I think there needs to be kind of that backup plan if mm-hmm. that is kind of the goal going into that type of a project.
Yeah, especially if that's the only way the project is going to work.
Mm-hmm.
I don't even really like talking about these kinds of projects because that's not the type of projects that we do. I'm not a huge fan.
But we see them. We see people doing them, and I think that's why we're trying to make this point. It's very, very difficult to do that, and very unethical as well. So that doesn't even align with our values.
Yeah. I mean, obviously if there's a tenant not paying rent or something like that, that's a whole other situation. Or causing damage or something, that's a whole other situation. But we don't typically do these big turnover projects simply because I don't want to force someone out of their home just to, make a buck. So, but, everybody's different. Everybody has their own plan. Just understand, go through the plan and say, does this actually make sense? Is this a logical plan? Maybe it's a development project and they're like, we're going to build this in 6 months and your money's going to be back in 6 months and there's no shovels in the ground. So again, does it make sense?
Mm-hmm.
Can we put up a 10 unit building in the next couple months?
If you're going through the investor package and you do see kind of red flags, don't be afraid to ask the investor about that and say, I don't fully understand this timeline. Is this going to be complete in whatever, we'll use that one. Is this going to be complete in 6 months? Or are we putting shovels in the ground in 6 months?
Mm-hmm.
What's the actual plan that's happening here?
Yeah. So thing number one, when you're reviewing an opportunity, is the plan logical? And if there are any kind of gaps in that logic, like Jeff said, ask questions about it. And maybe they have a good explanation for it. Maybe they already have shovels in the ground and it is actually possible that things are going to be up in 6 months. Maybe the building's vacant for whatever reason and they can throw a bunch of tenants in there.
Up at market rent, yeah.
Yeah, so maybe there is already a plan in place, but think critically about these ideas because we want to make sure that they actually make sense.
So what else do we look for in an investor package, or what else should our passive investors look for in an investor package other than just mm-hmm. red flags?
So not only does the plan make sense, I think also does the return itself make sense. And there are a lot of different factors that come into do the returns make sense. Obviously, returns are going to depend on the type of project. If it's a flip project, it's all going to depend on what that after repair value is and what kind of injection of capital is going to happen to bring it up to that ARV. For us, we do more of the buy and hold multifamily space. So we're looking at active and passive appreciation. We're looking at mortgage pay down. We're looking at cash flow. So those are the types of profit centers that we look at for return on investment. And as an investor, you want to make sure that those returns actually make sense. So does the ARV actually make sense for this area, or is it like way out to lunch?
Where did the number come from?
Yeah.
Essentially, is the question to ask, right?
Yeah.
Where did you come up with that ARV, or how did you come up with it?
Yeah, and then from a buy and hold perspective, for us, there are some things that we have to use as projections. So for passive appreciation, we have to look at what the area typically sees year over year as appreciation, and then we use that as a projection moving forward. You can't pick a random number, so that's really important to make sure that there is some evidence for these projections. But again, you can only base a projection off of historical data. So as long as that's been looked into, ideally it's conservative. I know for us, we invest a lot in the Ottawa area. It sees a lot of like 5% year over year appreciation. We never use 5. We're normally closer to 3, just because we like to be a little bit more conservative. So, ask your investor, where did you get these projections from? Have you done the research to make sure that this actually makes sense? And, from your own, again, this is from a risk profile perspective, but is it a conservative estimate for what that projection looks like? So that's a big part of what the returns look like. I think it also comes down to the numbers that they've used, right?
Yeah.
We talked about kind of the projection numbers, your appreciation, maybe your vacancy rate. Do we have a vacancy rate?
Well, so now we're getting into, okay, now we're going through the numbers within the investor package, right? So have they accounted for all operational expenses,
Mm-hmm.
right? We're in Canada, it snows. Is there snow removal?
Mm-hmm.
What about garbage? Is it something that the city, that's paid for maybe in the property taxes? Is there a separate budget for it? Asking about just all of the different types of expenses that there can be. And then, is there a reserve fund? Is there a vacancy allowance? And is that an accurate number? Where did the vacancy allowance percentage come from? Typically, we use a percentage of the rent for it.
Mm-hmm.
And what does that look like? What is the vacancy percentage in that area?
Yeah, you can look up vacancy percentages just so you're aware, so you
Yeah.
can actually verify.
You can verify this for those
Good
areas.
old Google will help you with that.
Yeah.
So you want to look at what those numbers are. I think the reserve piece is really important. You talked about a reserve fund, but we talked about vacancy. Do they have a maintenance budget? What is the plan if the roof needs to be replaced in a couple of years? What's the plan if the windows need to be replaced in a couple of years? Do you plan to do a cash call, or are you going to create like a savings plan of some kind? So understanding, again, comes down to making sure that you're also educated as a passive investor, but understanding a little bit on how a building operates and making sure that they've accounted for the basic expenses. I mean, we all know like utilities, property taxes, like that kind of stuff, but are they also creating a fund for changing light bulbs, changing dishwashers, because dishwashers always break, changing out other appliances. I'm pointing out dishwashers because we're changing a dishwasher in one of our units right now.
And it's not the first one you've had to change.
Always break.
Yeah.
But do they have that maintenance budget for those things? And the maintenance budget is different than the CapEx budget. So do they have those two? Are they confused? Do they have those two all in one spot?
I think just understanding that they have the proper budgets in place is the
Mm-hmm.
biggest thing, because what I've seen is that some investors will not have those budgets in place to make the numbers look better, right? So if I don't need to put an additional $20,000 in a reserve fund, then all of a sudden my cash on cash and my total ROI is going to go up, and my investor package and my deal is going to look way better. But we're not mitigating risk, right? There's more potential if there's no reserves and there's no budgets for any of these expenses that will happen eventually. Mm-hmm. Especially when you're talking about buy and hold real estate. We're talking
especially
10 plus
multifamily,
years.
like you're talking bigger buildings that there's more potential for things to break down.
Then what's gonna happen with this is now there's gonna be a cash call later on.
Yeah.
Right? At some point during this deal, if the reserves aren't there, if the budgets aren't there, there will be a cash call.
Yeah.
So now all of a sudden your return starts to look skinnier. But if you can get ahead of that, so what we do is we put these budgets in place, right? So we'll make sure, and maybe the return looks a little bit skinnier on the ROI in the investor package, but that would only be because there's additional funds that are there for a reserve.
Yeah, and I'd
Or
rather
mitigating risk.
Yeah, I'd rather mitigate risk and prepare for those types of things and have that reserve fund in place than, promise these things and then you're like, oh, never mind, we have to pay for all these things, so that cash flow, or we have a vacancy, and guess what? Even a tenant turnover, even if you're not vacant, tenant turnover is still vacancy, which is
And costs
often
money.
Yeah, unless you're able to do like boom with a tenant turnover. If you have a week where you have nobody in there, it's a vacancy. So
Well, and then typically you have to go in and paint and do patching and cleaning and all that, right? So there's additional costs whenever there's a turnover.
yeah, so is that all being accounted for? We would rather do that and have that accounted for and be a bit more realistic with what we actually think is going to happen with the property than overpromise. So
Yeah.
these are the types of things to look for when you're looking through an investor package. If they haven't shown you the expenses, make sure that the expenses that they've included, ask for them. And obviously if they ever don't want to show you these things, that's a concern. So this is also a part of that return on investment. Again, we've talked about the fact that these can affect the return that is being shown in the package. So going back to, does that return make sense? Are these the numbers and the cash flow return, does that all make sense? And I've seen a lot of passive investors go for these like wild returns, and the deal itself doesn't necessarily make sense for that return, but because they get like almost those blinders when they see these massive ROIs, that's great, but does it actually make sense, and is it actually dangerous what they're offering to you? And that's whether you're doing so a lot of this has to do with equity partnerships, but that's whether you're doing an equity partnership or a private lend. Because if they're offering a wild return for a private lend, you want to make sure that they can handle that type of debt.
Mm-hmm.
So,
And that there's a proper exit for that. How are
Yes.
they going to pay that debt back? What is the exit plan, and is there a plan B, right?
Yeah.
Again, mitigating risk, multiple plans, multiple exit strategies.
Yeah, so don't get like blinded by these like really crazy returns, because I've seen a lot that they are too good to be true.
Mm-hmm.
So, caution, always ask questions, make sure it makes sense, don't get blinded by it. And even if it's somebody who has a good track record, you still want to ask these questions, unless you've worked with them multiple times, and you have that trust built already. I'd still say ask questions, but you've built a bit of a trust with them. But always ask if it doesn't make sense to you.
Yep.
If there's like a missing piece to something. So don't get blinded by big ROIs. Ask questions. Go through the investor package. Make sure everything makes sense. The other thing that I think is really important is where the deal is.
Location.
Mm-hmm. You want to make sure that the deal that the projections make sense for the area, but also that the plan for the deal makes sense for the area.
Right. So actually, it's interesting. So one of my students had a project that he was doing. It was a duplex that he converted to a single family home. So it's almost backwards from what and he's been on this Power Lunch, and he talked about this exact deal actually. So you can go back to our YouTube and you can watch this video that we did. But it was really interesting because typically you're looking for highest and best use. Adding units is normally what we go for. But the neighborhood didn't make sense to have a duplex. It was actually worth more as a single family home. So he did a deconversion is what he called it, and turned that duplex into a single family home and was able to sell it for more than what he bought it for because of the area and understanding what that area actually needed as far as location.
Yeah. Other things I think about is like if the plan is to do like a short-term rental, does it make sense for that area? If the plan is to do conversions of some kind, does it make sense for that area? So you want to make sure that whatever the project entails, short-term rental, medium-term rental, long-term rental, does that plan actually make sense with where they are going to be? Again, tenant turnover. If you're in certain provinces, the rules are different than in other provinces. So does it make sense in that province if that's what your plan is to make the project work? So does the plan make sense for the area, but then also does the area make sense, period? So I'd like to ask people, like, why did you pick this area? I ask my students this all the time when they're looking in an area for an investment. That's great. Yes, you ran these numbers. The numbers, they look okay. You're right. This might be an interesting project, but why this area? Why did you pick this area to invest in? And a lot of them get caught up because they're like, oh, I don't know. I found a deal.
It was a cheap property.
Yeah. The cost per door made
cheap
sense.
For a reason, probably.
Exactly. So you want to make sure that the area itself makes sense. Is it a good area to be investing in? Does some of the things to look at, is it a growing or a dying town? Is it close to a primary market? If it's a secondary market, is it close to a larger center or is it not? Is it way in the middle of nowhere? Maybe it's a booming area, but it relies on like one industry, and if that industry dies, then what? So, there's a town that it's close to us, and it's funny because it's always got an industry, and the industry's pretty strong, but then that industry leaves, and there's panic, and then like another industry comes back to kind of replace it, and then the town's kind of okay again, and it makes me laugh. So I'm like, they're so dependent on this
one industry. This one big business that comes in and gives jobs to all the people.
Yeah.
And then they leave.
Yeah, then they go and they find a couple of years go by and they find a new factory and they go somewhere else, and then there's panic in the town. So, is the town relying on one source of industry, or is the economy pretty diverse where, if one kind of dies out, another will be strong? So you want to ask these questions to the investors to why they picked that area, and does that make sense to you as an investor? Yeah. Anything else about location?
No.
Yeah.
I don't think so.
You don't
just understand the location, and the investor that you're investing with. Again, we're talking to passive investors here. So make sure that the active investor really understands what type of location it is, what's happening with that economy, what's happening with the population. Is it growing? Is it shrinking? Is there a new industry coming in? Is the city or township or whatever easy to work with? Are they going to approve any development projects that maybe you're working on, or what have you? So.
And you don't necessarily need to become an expert in that area, but you at least need to ask the questions. I
like the term that I've heard. You need to become an ask hole, where you just ask a lot of questions, right?
Thanks, Mandy Branham.
I was trying to remember where that came from. Mandy,
That's
shout out to Mandy,
saying.
The JV queen, for coming up with that one. Become an ask hole, and just ask all your questions. Really try to understand why they picked this deal, ultimately.
I think that's actually where I wanted to end this off, is if you have any kind of beginning, or if you want a way to end the conversation you're having with a potential active investor, might actually be a good place to start, is why do you love this deal?
Yeah. The investor package should outline ultimately why they love the deal. It should really have the location, the details of the location, why this deal in general. It should have the numbers. Everything should be outlined in that investor package, and then questions can arise from that.
Yeah, but I think that's
you need to know what questions to ask And that's hopefully what we were able to help you with here today.
Yeah. But I think it's a really good way to start the conversation is, why? Why did you pick this deal? Why do you love this deal? If you're a passive investor, or even as an active investor, you're putting a ton of like blood, sweat, and tears into these properties. Why this one?
Yeah.
It's a good way to start the conversation.
For sure. And that's a good way to end this stream.
So I hope that helped. I know we don't always give a lot of love to our passive friends out there, but I hope this helped you feel more comfortable going into your next conversation with an active investor, because I know it can be, I don't know, I feel like it can be tough to figure out what you should be asking when you get into these conversations, and it's really important that you have a really good understanding of the deal, because that's going to help you make an educated decision, and hopefully the active investor can answer those questions for you, because in the end, you want to make sure that you're getting into a good opportunity with a good partner, and I think it's important to know these things before you do that, because if you're unsure, if you're confused, if you're not sure what to ask, it's hard to commit to anything.
Yep. Next week, we will not be doing a power lunch live. We will instead be doing a webinar.
Mm-hmm.
You will need to register for the webinar. This will not be live.
Mm-hmm.
We don't have the details for the registration right now. We will be sending that out, so you'll see it on my Facebook, on Dakota's Facebook. If you're in Wealth Genius, you'll see it in the inner circle. But there will be a way to register for that webinar, and that's what we're going to be doing next week. So we'll basically just use this same time slot to do that webinar, and we'll be showcasing a case study. So how we negotiated over $700,000 in equity on our last deal, and how well that turned out.
Yeah.
And then we'll be talking a little bit about our next deal, actually.
Well, we can tell you guys how it turned out. I think most of you know already. So it's how we negotiated this equity on the buy, but then how that kind of led us to be able to pull over $1.3 million out of this property within 6 months of owning it. So it's a talk that we've done a couple of times to a live audience, and it's been very, very well received. So we thought, why not share that with you? It's going to be very focused on basically how to create a deal. We always say deals are always created, not found, and that's really the case with this one. So we want to be able to share that with you. So if you are interested in attending, like Jeff said, it's not going to be live on Facebook. We're going to be doing a webinar, so we're going to be on Zoom instead. So you will need access to that. And if you want to be there, it's going to be a great talk. Make sure you send us a DM, and we will send you the way to register. So that'll be next week.
Yeah.
We're excited about it. It's a good one. Whether you're active or passive, it's an interesting deal. It was a huge success that we saw, and we're really excited to share it with everybody.
And that we created.
That we created. Yeah. Yeah.
All right. Well, that's it for our power lunch this week.
Yep.
So we will see you on the webinar next week.
Yep. Send us a DM. We'll send you all the registration details. You'll want to be